Hi, I'm Max Keiser. This is the Keiser Report. As we do at the end of almost every quarter, we got to look back, look forward. Where are we in all this crazy world we live in? Stacy.
Hey, Max. Well, remember, 10, 11 years ago when we first started Keiser Report, there was the beginning of the introduction of the temporary measure of quantitative easing. QE1 was then launched around that same time that we launched the Keiser Report. Then there was QE2, then there was QE3, then there were all sorts of other measures that they named all sorts of weird things. Well, look at some of the consequences that we're now having. And these consequences, they're saying, are transitory for their temporary measures. So in an interview this morning on NPR, Bostic, who is the president of the Atlanta Fed, said, quote, temporary inflation is going to be a little longer than we expected initially. Rather than it being 2 or 3 months, it may be 6 to 9 months, which will become 9 to 12 months, and then 12 to 18 months, and then 18 to 24 months. And that's how quantitative easing was unrolled and unveiled to the population.
Right. We predicted that inflation that would show up in the CPI would show up in prices for stuff actually pay. I think housing was up 25% in the last 12 months, for example.
Yes.
We said, hey, that's going to be the outcome of all this money printing. And once it gets through the labor sink of having Chinese labor in all of our manufacturing jobs shipped to China. But now you've got wage parity between China, the US, and around the world. So you don't have that sink that is hiding the money printing anymore. So now it's just the money printing is like a washing into the economy in the form of these higher prices. And once you get the inflation, there's that concept of the inflation genie being out of the bottle, right? It's hard to stop it because expectations begin to play a part. People start panic buying things because they fear the price is going to go up. And when Bostic, who's over there at the Atlanta branch of the Fed, right? He is openly, prevaricating. How do you like that for an Ivy League word?
Well,
I didn't say he was lying, did I? He was prevaricating.
Yeah, that's called Fed speak, right? So you mentioned expectations, and this is something that we've also been covering, is that the mindset. Once the mindset changes, it's hard to put it back where they believe it belongs, right? So part of the reason why, the Fed and their academics in their ivory towers thought the inflation would be transitory is that the higher prices would pull in more supply, i.e. manufacturers would start manufacturing more stuff, suppliers would start supplying more stuff, but that hasn't happened. And part of it is to do with, at the same time as Bostic at the Atlanta Fed is saying that temporary inflation looks like it's going to be a little bit more permanent than we thought. Well, the Fed's Powell said enhanced unemployment benefits may be a factor in limiting job growth. Not only did workers get all these enhanced unemployment benefits, and for the first time for a lot of people, they had huge income increase, a pay rise. Whereas like the PPP was even billions more given to all sorts of LLCs, corporations. They got a lot of money in bailout. So again, they also don't need to get out of bed to work. So we have a situation where the supply is not coming on board at the moment. And so the inflation, it's setting into the expectations of mindset.
Right. It's scary when you hear professional economists say things that are patently false and are not based on any economics that anyone's ever learned in school, ever.
Yes.
Because the price signal that is being referred to there, that is evident in the business cycle, that you would see higher prices would bring in more supply. That's true if there's an economy with an underlying fundamental valuation of the money itself, like a gold standard, then you have something called the business cycle. But when you remove the signal of gold and you put in only the signal of central planners, then you can't have the expectations that you would ordinarily have. And you have now runaway, what's going to become runaway inflation. Prices are not going to come down. There's a rant of me on YouTube begging for the central bank to raise rates. When I was in Rotterdam a few years ago, and I'm screaming, actually, I'm saying, you've got to raise rates, right? It's the opposite of the Jim Cramer rant from the 2008 crisis when he was begging the Fed to lower rates. I was begging the Fed to raise rates as a way to stem the tide of what's becoming a price signal nightmare and this runaway inflation that's now taking off. And so having been the only one to predict this, having been the only one to identify the cure, let me be the only one now in any mainstream outlet to accurately predict what will be the story a year, 2 years, 3 years from now. And that is inflation will continue to ramp higher, and the fiat money currencies, particularly the dollar, will continue to be challenged. I see Russia has now hit the eject button. They're not in the dollar system at all. Okay, so we've got a lot more countries hitting that button. El Salvador hit the US dollar eject button, basically, by going Bitcoin as legal tender. The Americans are going to be really in the most dire of circumstances.
Well, I'll slightly disagree with that because the data from the Fed will show that there has been a group of people, and that's the top 1%, who do very, very, very well with inflation or even hyperinflation. Those are all the asset holders. Those are the people, as you mentioned, house prices were up 25% year on year in May. And who owns all the property, but big private equity firms like Blackstone, or very wealthy people who own many homes and things like that. So there are some people doing very, very well from inflation, and they like it. You will see on the cable news, though, you will see, especially on the financial cable news, they will argue that inflation is good for the ordinary person. And the Fed data will show you that we're going to get to in the second half. It'll show you that, in fact, it has not been good for the ordinary person. The Fed inflation has not been. Maybe the stimulus directly from the government might have helped them, extend and pretend a little bit. But the inflation is worse for the people who have to spend the most on food and shelter, the percentage of their income. It's worse for them. Now, in terms of the housing, of course, as you mentioned, the business cycle hasn't been allowed. We keep extending and pretending those temporary measures of the moratoriums on rent and mortgage payments. So this is part of the problem with why supply, despite higher house prices, why supply is not coming on, why people aren't selling their houses, despite the fact that they could get more money. Well, it's because they haven't paid their mortgage for the last year and something. And so they want to, the moratoriums keep getting extended. So maybe if you get to live for free for another 6 months to 12 months, why would you want to sell your house and try to move somewhere else? Plus, the bank theoretically owns it because you haven't failed to pay your mortgage. So because of the clampdown on moratorium on evictions, you're not seeing supply come on. Nevertheless, the tight supply of houses on the market, again, we're talking about the Fed and their temporary measures that began in 2008 and continue to this day. Just to put things in perspective, U.S. existing home prices have hit fresh all-time highs in tandem with Fed balance sheet. So this goes back to 2005, and the yellow line is the Fed balance sheet, and the white line there is the housing prices. As you see, they are going up in lockstep, especially over the past year as it's gone parabolic. So both have gone parabolic at the same pace and the same rate. And the Fed says they don't cause this. They say the Fed addressed our concerns recently of the Cantillon effect, and they claim and they insist that their policies do not cause a wealth and income gap, certainly a wealth gap. And that shows you, however, the home prices going up lockstep with the Fed's balance sheet. They're buying the mortgage-backed securities, which enables more money, more leverage, more funds to go into the limited supply of housing. So, just look at the data. You could believe the Fed or you could believe your own eyes.
Yeah, it kind of reminds me of the phenomenon we saw in the UK when Thatcher opened up the public housing stock to privatization. And you had everyone was able to buy their home at below market rates. But within a few years, it became part of a bank-led housing Ponzi scheme, which we have been witnessed and seen grow for 20 years. And it took housing out of reach from the average British person. They went from needing 1 or 2 or 3 times annual salary to buy a house to needing 10 to 15 times annual salary to buy a house. So therefore, it was not affordable. And then the government doubled and tripled down with more schemes, buy to help, for example.
Help to buy, started with right to buy. That was Margaret Thatcher's theme. And it's all about time, right? Because it becomes intergenerational. So what debt is all about is valuing time, and interest rates are valuing time and time value. So the generation in charge always gets to say, well, let's roll it over and we'll come up with a plan in the next 20, 30 years for sure. We'll grow our economy so much that the children or unborn grandchildren at the moment, we'll figure a way out by the time the debt rolls over onto them. And we never, again, that's the plan. These temporary measures are supposed to have a permanent solution, and the permanent solution never comes because mathematics, right? It's just the mathematics, as Einstein pointed out, of compounding debt, compounding interest rates. This is the inevitability.
Right. And in the UK, you had these property barons emerge where they owned hundreds of properties. And then during the 2008 crisis, of course, they all went bust. They needed a bailout. And then the taxpayer ponies up the cash for that. Yeah. So here in the US, BlackRock and these other, like Warren Buffett or Berkshire Hathaway, they've become the new property barons. The biggest owner of houses in America right now is a private company called BlackRock. Blackstone.
It's so confusing all the time.
Yeah. So here you have the transition from home ownership as part of the American experience, or dream, as some call it, to being outsourced to barons who are now going to engage in price gouging. So when you see the price of property, houses up 25% a year, that's not because the market is reflecting GDP growth or wage growth. No, it's reflecting price gouging by slumlords, in this case, the black stone. Yeah.
Right. And I want to say in the last moments of this first half, I just do want to point out that there is, on paper at least, some benefit toward less of a home ownership and more renting, because you're obviously more agile, you can move around, go to where the jobs are. However, that is an economy with jobs, like China, say. We don't have jobs in America. All we have is money printing. So you need the assets if you're in an economy solely about money printing. If it's only cantillionaires, is your only way to wealth is via cantillon effect. You've got to have an asset that the Fed is going to pump. So yeah, all these people, younger generation, being forced off the property ladder and into renting, it doesn't look good, and we'll get to that in the second half.
Yeah, we're going to take a break. Data. When we come back, don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to return to our quarterly review of where we've been, where we're going. Stacy. Right,
so we were talking about the temporary quantitative easing and Fed intervention measures, the central bank intervention measures that began in 2008, 2009 during the financial crisis. They continue to this day, all these more than a decade later, and they're starting to cause what they call transitory inflation, which is now they're starting to begin to dull those expectations that it's just going to be transitory. They're saying, as we discussed in the first half, that the Atlanta Fed president says, in fact, it might not just be 2 or 3 months, it's going to be 6 to 9 months, and they're going to keep on extending that. So we mentioned those moratoriums on evictions for rent, failure to pay rent or mortgage. Well, there was another story out this week, just the largesse of this money printing and the panic issuing of debt last year, trillions that the U.S. federal government borrowed. So real money, right? It's not just Fed credit. And we saw that, as we covered, that in California, Gavin Newsom is now going to, they got paid so much money from the federal government that they couldn't spend it all. And so what they're doing in California is that Newsom is going to use these federal tax funds and pay off all the rent that has not been paid for over the past year. They're also extending the moratorium on rent into September. The article about this, when you read these articles, there are people with over $100,000 in back rent that our federal taxes is going to shift to California, which is the biggest economy in the United States, one of the biggest economies in the world, and yet people from Alabama to North Carolina to Maine and Idaho are having to pay for the property barons in California, because the fact is that the rent, it's pitched as just like the Fed's temporary measures are pitched to help these people, the tenants who are renters, who can't afford their rent. We're going to pay their rent, i.e. to the landlord. The landlords get to capture the 25% house gains. They don't have to share it with the federal taxpayers. They get to keep all their gains, but we pay their, the lease to them, their toll for this rentier economy.
Right. So it's another bailout, just like 2008. Remember, all the subprime lenders were made whole.
Yes.
They were bailed out, and then their credit lines were expanded.
Yes.
Then they got into, from all the people who had to throw their keys back to their lender who got bailed out, particularly in the communities of color, by the way, got disenfranchised, the biggest disenfranchisement of Black Americans since slavery days. Okay, that's what happened. Thanks, Warren Buffett. And so this happened again this year. The government decided to bail out Warren Buffett again, Blackstone, and Wall Street. Those are the landlords. And they're using it with federal tax money. So Max and Stacy. Not only did we have to pay for Obamacare, which is a transference of liability from the government to taxpayers like Max and Stacy, now we're paying Blackstone and Warren Buffett's extended over leveraging themselves in the real estate market. Mm-hmm. Again, that's not capitalism. Capitalism is you take a risk to make a reward. It's if you take a risk and you get paid off by the state, that's called a kleptocracy.
Yes. Right. So, the headline on that reads, Newsom says California will pay off all unpaid rent accrued during COVID pandemic using $5.2 billion pot and rent forgiveness on a scale never before seen in the United States. Again, it's transferring from the rest of the 49 states, the taxpayers of those states, to California, which is the richest of all the U.S. states. And yet, none of the other taxpayers get a cut of that. They don't get paid back especially because it's a California state, right? It's not the federal government. You're not going to get some tax cut out of it. Just the taxpayers, the homeowners, the landlords of California benefit from it.
Right. And by the way, so the homeowners, they still don't get any kind of relief on wages that are still kept artificially low. The house prices, as we mentioned, are skyrocketing, so they won't be able to afford a house less affordable than it was last year. The increase in the house price will be used to justify higher rents by these landlords.
Yeah.
So, you end up with the casino gulag, as I've been talking about for years now. It's like Blackstone has a gulag called the American housing market. And I'm sure, and I made this prediction a few years ago, that Blackstone will sell off their property of huge American homes to a Chinese bank. I'm absolutely sure that's going to be the case.
It doesn't, at the end of the day, it doesn't matter. The fact is that whoever is benefiting from 0% interest rates, the top 1%, they're the ones that benefit according to the Q1 data that the Fed just released. Whoever has access to the Fed's discount window, the Fed funds, that they get to borrow at 0%. This is the 1%. This is the data just released last week from the U.S. Federal Reserve, and it shows the wealth of households in the United States. This is the data. The top green line is the top 1%. As you see, this is the next 9%. This is the next 40%. So these are the top 50%. All of the gains went to the top 1%. That is a rentier class. That is the quintillionaire class. Whoever has that sort of rate of borrowing, whether it's in the United States, China, Europe, it doesn't matter. LVMH got to buy Tiffany at the same sort of discount rate. Whoever, that's the global class that gets the free money from the central banks, wherever they are. And it doesn't matter nationality. The fact is, this is the system of temporary measures that creates this oligarchic class. And it's in the Fed's own data. This is their data. It's not mine.
It's financial apartheid.
Yes.
Right? So we don't get access to 0% money. So we're being victimized by apartheid in America, perpetrated by our own government against us.
It's all the central banks.
Yeah. Okay. Well, that's true.
Most of them.
Okay. Around the world, you have the apartheid model is being adopted by central banks using interest rates to create Bantustans of ghettos. These people who are paying now, we're paying Blackstone's tab here. That's because we're living in the ghetto. We're in the ghetto. We're in the frickin' slum. We're in Wall Street slum. Unless you're getting 0% interest rate, you can buy companies for nothing down and all the earnings accrete to the bottom line instantaneously. You're living in the hood, my friend. We're all in the hood.
Right. So let's look at that data that the Fed released in terms of the household wealth, which showed how much money, especially the massive, dramatic interventions by both the Fed and the U.S. Treasury last year to intervene on behalf of like the pandemic and the global lockdowns, how much money they printed and where it all went. Because on the surface, in the media, it was all about helping the ordinary person. But look at how much they helped the top 1%, according to the Fed's own data. We all know Jeff Bezos, the richest man in the world, made $88 billion in wealth last year. His wealth increased by $88 billion. Well, the 1% of 126 million U.S. households, according to wolfstreet.com, so that is 1.26 million households in America, are the prime beneficiaries of the Fed's actions. At the end of Q1, their combined wealth was $41.5 trillion for an average of $32.9 million per household. Over the past 12 months, their wealth increased by 7.9 million per household. I guess if you do the numbers on that, their wealth increased by 20% last year, the top 1%. Their household wealth increased by 20%. Now cut to the bottom 50%, okay, who have almost no household wealth. And of their household wealth, about 80% of it is just durable goods, i.e. your washing machine and refrigerator. It's not even any equity in the house, so they're not gaining from that 25% increase in property prices. Well, the chart below shows the wealth of the bottom 50%, red line, on the scale of the next 40%, which is the green line. This wealth of the bottom 50% has grown by only $14,000 in 20 years. So not adjusted for inflation, of which 10,600 occurred just over the past 12 months, thanks to the stimulus checks. So that's the chart. That's the bottom 50%. This is the next 40% above them. So only $14,000 in the bottom 50% in 20 years. 10,600 came last year. Again, to put it into perspective, Jeff Bezos, his wealth increased by $88 billion last year, which is the equivalent of about 9 to 10 million households in this bottom 50% of the U.S. economy. How much he made from the money printing, from the Fed's policies.
Right, it's gaming the system. So there's two things to keep in mind here. To disabuse people of the Horatio Alger myth of, well, these people work hard and they make a lot of money. That's not true. There's two things operating here. Number one is, as we've been talking about in great detail, and that you're free to review these data if you'd like to, it's theft. It's theft. It's just it's a coordinated corporate government theft, and the people who are being stolen from are increasingly being called deplorables.
Yes.
Or they're being essentially a scapegoat. So we saw this in the 30s in Germany. People are scapegoated, their wealth is confiscated, and the people who do the confiscation think they're closer to God. This is America today. The second thing is, if you want to compete with those people, you must strip yourself of all morals and ethics. And that's really hard for most people to do. I worked on Wall Street for many years. I could still be on Wall Street making money on Wall Street. But at some point you have to ask yourself, am I willing to be a Wall Street thief, like a Jamie Dimon, for example? And I've said that many, many times. He's never disputed it because he can't.
It's however, you know how that co-locating your server next to the Wall Street, the actual Wall Street, trading desk to siphon off wealth from the rest? Well, that's the same. You have the closer you can get to the New York Fed, the closer you can live to it, the closer you can siphon off the wealth of the money printing. Again, just in the last moments here, I want to show you the data. That's the top 1%. This is the Fed's data. This is the Fed data that they provide, showing you what the wealth gap between the top 1% and the rest of the Americans. You know, when the deplorables say they want to make America great again, they're basically talking about when the wealth gap wasn't so huge. Now they're lorded over and mocked and called deplorable because look at how much since the financial crisis especially. And in the last year, look at that parabolic move in the top 1%, how much their wealth increased while nobody else's did. So the majority of all the help, those temporary measures to help the poor people actually just helped the wealthiest. So it's a rigged system, and you have to take down the system in order to even help anybody else, because it all funnels to them no matter what.
All righty. Well, that does it for our quarterly review. Look back and look forward to what we can expect. It sounds like more of the same. Well, until next time. Bye, y'all.